Hey, this is Seth Peek with Peek Realty and Peek Painting in Atascadero. And once again, joined with Harry Bennet from Equity Reach Mortgage. What's going on, Harry?
Yeah, always a pleasure, man. Always a pleasure.
What are we talking about this week? We're talking about debt to income ratio. We're talking about the really fun, non-boring items that to get ready for your mortgage and to make sure your finances are in order,
Yeah,
right?
roll up your sleeves for
Yeah.
this one. So, I mean, if you really want some reading material, you can start reading all the guidelines for Fannie and Freddie and go through everything and really go deep on it. But I think we'll just touch the surface a little bit of each program.
Well, let's at least start with like debt to income, which means you're comparing how much you owe different entities to how much money comes in per month, correct? I mean, it's as simple as that.
Correct. Yeah. So if you're getting $10,000 in a month, that's the income. If you have so what we calculate is two forms of debt to income ratio. So typically, mostly everyone's always focused with the back end, but there is a front end, and the front end is basically what your housing expense ratio is, right? That's just what your income is divided by what is the proposed mortgage. Now, everyone is usually mostly concerned with the back end, which is the housing ratio plus all of your consumer debts that you currently have monthly.
Okay, so basically, the simple form, like the most basic, most households, it's two incomes nowadays, right?
Yeah.
So if someone's got a car payment, if they have a credit card, a standing revolving balance, right? Would be a revolving balance, and then what else would someone have to look at? What's the most common?
The most common I see student loans. Even if you're in deferment, we still need to calculate a payment.
Right.
So a lot of people will be like, oh, I have an $80,000 student loan, but it's deferred. So don't, that shouldn't be included. That's false. We have to include it. We have to make some type of a payment. And typically it's going to be a 1% of the balance is what our payment is going to calculate to, unless we go with a different program, could go down to 0.5%. The other one is going to be like usually car payments. We always see car payments on there, credit cards, usually personal loans, pretty much anything that was extended to you in a form of a extension of credit. Also, IRS tax payments. That's a very common one I usually see. And then alimony and child support would be included as well.
Gotcha. And even child support. Yeah.
So what we'll do is we'll calculate all the payments that are going out, right? That's the part of your back end debt. And then we'll add it to your proposed mortgage, right? Divided by your income. That's what gives us the DTI range. And so that has to be in an acceptable range in order to move forward and get you pre-approved and then, eventually have that loan approval.
Right. Different loan products require different ratios depending on the individual.
Yes. Yeah, exactly. So FHA, they're a lot more lenient with debt to income for individuals. So they will allow you to go up a little bit higher towards that, a little bit, 55%, right around there. Conventional, they have a dead stop at 50, and nothing you really need to remember. It's just that, you kind of know, well, okay, FHA is a little bit more lenient. Conventional is kind of in the middle of the road. USDA, they're way conservative, right? So that's usually the biggest deal killer I see with USDA is that everything looks and matches up, but they're so conservative. They're usually like a 41%. So unless you're going to be less than 41% of your income, it's a little bit harder on that side to get.
Like Dave Ramsey always says, like eat rice and beans and own a car, no car payment before you buy a house.
Yeah, I think his recommendation is don't have your mortgage payment more than, I think it's like 30% of take home pay.
Right.
Which it's like, okay, if you live in California, good luck, bud.
I know.
You'll never own, in that aspect. I mean, unless you have a big inheritance and you put down a large amount.
Right. Yeah. You got a grain of salt.
Nowadays, what's the medium sales price around here? It's what, 650,000 somewhere.
Yeah. North County about 650 in A-Town. Yeah.
Yeah.
Well, right on. So any other like quick tips about debt to income ratio that you think we should?
Absolutely. So let's just say if you're the type that stays at home, you want to kind of like self-diagnose, which I don't really recommend. I'd reach out to some lender and just say, hey, I want you to kind of just, guesstimate where my DTI is before even taking the application. That's what I do anyways, because I like to know, hey, it looks good on paper before we actually send the application to you, right? So if you have less than 10 car payments left on your car note, usually we can omit those. So check with your loan officer, see if that's something you can omit. So anything that has less than 10, typically we can't. If it's a lease, if you're in a lease and you have 2 payments left, it doesn't matter. We have to still hit you for those 2 payments because it's expected that you're going to have
Gotcha.
another lease coming out. So that'd be my tip.
I'm trying to think if there's like the sticky one. Do people often find once they get in the process of getting a loan and they pull their credit report and they find out that there is a bad debt that they didn't either know about or they had ignored for too long and it's still there? Well, like a medical debt from like years ago that's in collections, does that affect your debt to income ratio or something like that?
Medical debt, no, not medical debt. As long as it's medical debt, if it's in collections, no, it won't. If you have other debt that's in collections, we'll have to calculate a payment for that. Unless it's a charge off. If it's a charge off, we typically don't have to calculate a payment for that one.
That's curious.
Yeah.
Like, why medical debt? It's still debt.
It's still debt technically, but they probably, what are we going to do? Either pay for your medical debt and get your arm fixed or amputate that sucker. I don't know.
Oh god.
But yeah, I mean, it's probably because the bills are so erroneous, they're so high that a lot of people have that and don't want to prevent them from home ownership.
Well, awesome. A lot of fantastic tips. Not the most exciting topic, but honestly, it's probably one of the more like baseline foundational things you should know about your finances before you look into buying a home. Yeah. Because it's the first thing that's going to let you know how much you can afford, correct?
Yeah. Again, if you're the type that's, wanting to write this down and kind of talk with your family before you even talk to someone like me, I totally get it. And with me and most probably other really good lenders, they're going to talk to you for at least an hour before taking your application because they really need to get to know you, like where your situation is. Because I personally am in the business of saving time, really. I don't want to send you a loan application, make you dig out all your W-2s, all your pay stubs and everything and go, you know what? This is not going to work. I would rather tell you like, okay, this is where we're at. You're probably going to get approved for about this much.
Right.
Is this what you're looking for? Yes or no? If it's a no, okay, well then how do we get to the yes part? Right. Maybe we need to add in a co-buyer or have a different, scenario.
Sure. Well, awesome.
Yeah.
Once again, I'll see you next week, Harry.
Love it.
Anywhere in between. I hope you have a great day.
Sure.
Thanks for joining us, everybody.
Absolutely. See you guys.